The IMF has said that the estimated hit to the global economy from the COVID pandemic will amount to $28 trillion in lost output, describing the coronavirus as the worst crisis since the Great Depression. However, with the vaccine rollout underway, markets at least are feeling optimistic about the recovery. So joining me to discuss the outlook for the global economy in 2021, along with some investment opportunities, is Daniel Lacalle. He's the chief economist at Tressis. Daniel, great to chat to you. When we think back to the events of 2020 and the impact on the global economy, how bad has it been compared to sort of what you were expecting? Because the IMF has actually said that it wasn't quite as bad as they had anticipated. So how did it align to sort of where you were tings back in March, April time?
Well, thank you very much. I think that the first thing is that what we have seen since March has been mostly downgrades to global growth. It is true that from September, we have seen some improvements and some tweaking around the edges. But I think that in general, if we look at the consensus estimates at the end of February, beginning of March, most people were thinking about a very small hit to the global economy. I think it's been much larger than that. More importantly, I think it's been extremely severe on the job market. I think that if anything has been a negative surprise about both the slump and the recovery is how poor the job market and how weak employment has been. So I think that in general, what we can say is that it's been a very, very negative year for the global economy, that overcapacity that already existed in 2019 and 2018 has exacerbated the problem, and that despite the stimulus packages and the different measures implemented by governments, the reality is that we're seeing an almost jobless recovery in most developed nations.
So an almost jobless recovery, that sounds quite intimidating. I just spoke to one guest earlier who says that he's anticipating the biggest worldwide economic bounce in 15 years in 2021. I was wondering what you think about that and kind of what sort of shape of recovery are you expecting?
I find it interesting. I think it's not going to be as optimistic as what we see from the expectations of investment banks and the international bodies. I think it's going to be a much weaker recovery, fundamentally for three reasons. The first one is the accumulation of debt that is going to make that so many corporates have to decide in 2021 to take drastic measures to rein in the balance sheet and to improve their position, their solvency position, which is going to significantly impact the capital expenditure, the investment landscape. I think that the other problem is huge levels of government debt are going to drag on growth, because most of the deficit financing that we have seen in 2020 has gone to perpetuate imbalances that already existed in 2019. It's not just to aid the economy. Most of it has been to perpetuate current spending. And that obviously doesn't help in terms of the recovery. The third, in my opinion, is that most of the expectations for 2021 that we're seeing out there, that have between 4 to 5% recovery in global growth and a very abrupt, very aggressive bounce of the Eurozone and US economy, estimate multiplier effect of stimulus plans and monetary policies that has never existed. It's unprecedented. So we need to be extremely cautious about things that have never happened, because they tend not to happen. My view, therefore, is that what we will see is likely a K-shaped recovery. K-shaped recovery means that we will see some sectors thrive, technology, everything that has to do with high productivity, everything that has to do with fresh foods, recovering very quickly, even faster than the September to December period, and more importantly, even higher than they were in 2019, while small and medium enterprises, industrial sectors, everything that has to do with sectors that already suffered from weak margins and overcapacity in 2019 and 2018, those are likely to see the low part of the K.
So what should we be expecting from some of the major central banks in 2021? We know interest rates from the Fed and elsewhere already at the lower bound, already at rock bottom. Where do they go in 2021? Do we remain low for a considerable amount of time? Will we continue to see further stimulus, or are we edging back towards normalization?
I think that the prospect of normalization is non-existent, in my opinion. Central banks have already said that even if inflation starts to pick up, they will not change the path of their policies until it's a prolonged period of above 2% levels of inflation. In any case, if you look at velocity of money and if you look at the trends of inflation expectations, the reality is that it's very unlikely that we will see a sustained increase in inflation, at least at the level of official CPI. Definitely a big increase in prices of fresh foods, education, healthcare, which is another of the reasons why the economy will not grow and not be as robust into 2021, because despite low rates and massive liquidity, the most important expenditures of an average family, of an average household, are rising well above real wages and well above disposable income. So my opinion is that what we are likely to see is central banks being aggressively more accommodative, particularly from March to the end of the second part of the year, because the slowdown in economic growth is going to be very evident by then. And I think that we will continue to see very aggressive stimulus packages, very aggressive rate cuts. We are likely to see negative rates in the United States, and it is basically full Japanization following the path of the Bank of Japan.
So overall, it sounds like you're pretty cautious when it comes to the recovery. That's not necessarily reflected in terms of asset prices in the equity market. We're seeing some of the averages in the US hit all-time highs recently, really optimistic about what's going to happen in terms of the recovery next year. Do you think that the stock markets are overly optimistic?
Stock markets are overly optimistic. I think if we look at the level of bullish to bearish ratios and the different metrics that we all look about optimism in equity markets, it is clearly an environment right now in which we have seen the most optimistic expectations from investors in the last 20 years into recovery. But that is normal because it's based on two factors. One is the obvious base effect. 2021 in the first quarter is going to see some amazing base effect figures. We're going to see plus 10, plus 15% figures, basically because the previous ones were coming from a slump. No, the base effect obviously generates a certain level of confidence. I think also the fact that central banks have been so adamant about the fact that they will continue to support the economy no matter what is something that keeps investors relatively happy. And despite the elevated levels of debt, the fact that investors see that governments are willing to spend into the recovery also generate a certain level of excess optimism. I think that the problem is that it's too optimistic. Not that any of those factors are incorrect, but that the expectations of investors are too aggressive about earnings growth, about economic growth, and about the recovery in general. So that's why I think you have to be prudently exposed to equities, to bonds, and to commodities, but you also have to take into account that, as we saw in 2018, as we saw in 2019. And as we saw in the previous crisis, you have to be very selective. It does not work equally for European markets, for US markets, for technology, for cyclicals, or for oil or other commodities.
Now, in 2020, we've seen some weakness come through for the US dollar after essentially a 2-year bull run for the greenback. But you think that this weakness story has been overplayed. Tell us why.
Well, fundamentally because history tends to repeat itself when the measures that are implemented are the same. And if we look at the 2009 to 2019 period, the reality is that all bets expecting the dollar to collapse didn't happen. And this time is not different. Because, in fact, this time what we have seen is that the response from governments and from central banks all over the world has been so aggressive that global debt in US dollars has soared, that the demand for US dollars has soared. So I think that the idea that the dollar is going to collapse first did not even happen in 2020. If you look at the performance of the US dollar relative to the vast majority of currencies globally, it has actually strengthened in terms of the emerging market currencies, etc. It has basically just weakened recently relative to what? To the euro and the yen. Based on what? On expectations, like in the previous crisis, of a very rapid and strong recovery of the Eurozone and Japan. And reality kicks in afterwards. So I think that particularly relative to the euro, and particularly considering the rising imbalances in foreign currency that emerging economies are taking, I would be at least prudently viewing the US dollar to remain within the framework in which it has moved in the past 10 years, which is between 90 DXY to 100 and a little bit, not much more than that.
And just very finally, either geographically or in terms of asset classes, are there any investment opportunities that are really getting you excited for next year?
I think that, for example, there are things that have been massively overlooked in this crisis that look particularly interesting. I think that, for example, the energy sector, which has been maligned throughout these 3 years, is going through a transition that makes it quite interesting. No? I think that also there is a widespread view that in consensus that 2021, you basically need to be exposed to emerging economies and to Europe underweight the US economy. I'm exactly on the opposite side of that. I think that the situation of US companies is stronger, that the earnings outlook and the earnings downgrade risk of US companies is much lower than that of European or emerging economy companies. And in general, the three trends that existed, that happened, that were already in place before the COVID-19 crisis, technology, sustainability, and demographics, still play. So sectors like everything that has to do with healthcare, everything that has to do with the aging of the population, everything that has to do with sustainable development, and everything that has to do with the technology revolution continue to be very exciting opportunities. And they might be optically more expensive than the so-called value sectors, but we have to remember that most so-called value sectors are value traps.
All right, Daniel, it's been great to chat to you. Thank you so much for your analysis.
Always a pleasure. Have a great holiday and happy Christmas and a great 2021 to everyone.
And same to you. Thank you so much. And that was Daniel Lacalle. He's the chief economist at Tressis, talking us through the outlook for the global economy in 2021. Thanks so much for watching IGTV.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.